What is going on, you guys? Happy Sunday. All right, so we got a couple things to talk about here. I know that this is going to be a little bit later here on Sunday evening. It's about 8:30 where I am because I live in Minnesota. But I'm going to record this in the anticipation that a lot of people are going to be tuning in on Monday morning. So what I wanted to talk about here today was number one, the markets, like what ended up happening last week, specifically Jerome Powell. Like what ended up happening with what I need. So, like the jobs report, right? There needs to be a little bit more context about the jobs report, Jerome Powell's decision, and then more importantly, like where we were, like where we still are in the market cycle. Like, are we really is it really higher for longer, or what should we really expect moving forward? What is the Fed thinking? And more importantly, is that actually going to crash the market? So, we're going to take a look at the overall macro view of the markets and then cover briefly about what's going on in the jobs report, what was said in the FOMC meeting. But then we'll also talk a little bit about what's going on this week from an earnings expectation. Not too much on the economic calendar front. I think that it's not necessarily going to be this week. It's going to be too important, but it's actually going to be next week. So next week, that's actually going to be CPI. So we're going to get CPI and PPI data, which does feed into that PCE data, which is going to help us get a better understanding of like what we can really expect from Fed rate cut expectations moving forward. So let's get into it. So we got the S&P 500 right now. From a technical basis, this does look really overbought. What I'm getting a little nervous about right now is that you do see that the S&P 500 is definitely trading over that 200-day moving average and then the 200-week moving average. So the way that I like to think about it is every single time that the market starts to get overextended from that 200-week moving average, that's like the ultimate bearish view of where I could potentially see the markets falling down toward. Which from today, I think it's almost, and this is something that I just put in. It's about almost a 20% correction from today's levels. So that does have me a little nervous right now that we are that overbought. And then you see that weekly RSI overbought. But overbought can stay overbought for a long time. You do go back to this 2017 timeframe, this bull market, which was a very, very strong bull market. The weekly RSI hit overbought there. On the daily chart, you do see a lot of the same thing, but we've been overbought for quite a while, which sometimes that actually can be a bullish thing, bullish development. But there hasn't been that much breadth in the markets. So that's what definitely concerns me on that front, where it's really narrowing, specifically to tech names. We will go over briefly Amazon and Meta, which I think that were probably the most insightful tech names that ended up reporting this last week. I know Apple is part of the bigger tech, but from my perspective, like Apple is definitely a mature company. They're not really working on as much like Amazon with AWS or Meta with a lot of the AI things that they got going on. So those two companies right there are providing a lot of insights to like what we can expect longer term. So let's go over what ended up happening with the Fed meeting recently. So we will talk about this with Nick Timmeros. I got to just make sure. Okay, perfect. I got to make sure that everything looks good. This is obviously a live, so sometimes there's always going to be, I'm still learning. So the Fed basically did not end up raising rates, and they did talk briefly about quantitative tightening. So I think there was a couple of big highlights from this latest meeting is that they said that they weren't going to lower rates in this particular case. So we're still in between the federal funds rate of 5.25 to 5.5%, which has us roughly at about 5.35% on the effective federal funds rate. What they ended up doing is they really gave a lot of guidance, and it was overall the best way to really describe this meeting is it was a punt. So they definitely punted this meeting, and they said, hey, maybe next meeting we're going to have a little bit more detail. I think that the next meeting is going to be the SEP meeting. So that's the summary of economic projections, where the Federal Reserve and the Federal Reserve's voting members will talk about like what they expect from rate cuts moving forward, as well as like their economic projections, like where they could see unemployment going to. So we're going to definitely have to pay attention. The next meeting is definitely a lot more important. More importantly, during the Q&A portion, when Jerome Powell was talking to the pressers, he did mention that quantitative tightening, that they were going to discuss that heavily in the next meeting, which basically means that they could potentially reduce the, let me actually pull that up, that they could potentially reduce the pace of their quantitative tightening. And that has a lot to do with the reverse repo facility. And I'll pull this up here for you guys and then share the screen. So it's still loading, so bear with me here. The reverse repo facility, the best way to think about this is that this is like excess liquidity that ended up being pumped into the markets during the 2020-2021 timeframe. So it's actually pretty cool. I think that I may actually just deviate off of what I had planned for you guys and actually show you this. So funny thing is that during 2021, the Federal Reserve was obviously printing about $120 billion per month. What ended up happening is that the Federal Reserve expanded the reverse repo facility, and they allowed money funds. Oh my gosh, I'm totally drawing a blank. It's been a long day. They basically allowed they expanded the people who can actually participate in the reverse repo facility, and which acted as like a release valve to the overall like banking system. Funny enough, it was like within days of them expanding who can participate in the reverse repo facility, ARK Innovation ETF actually ended up popping. So I thought that that was a really interesting correlation. I'll have to talk about that at a different time because I didn't really prepare too much and should pull up all the charts, and I just want to make sure I can get through this in like 30 minutes or so. But that was really interesting. So, but this is going to zero, and right now I think it's like a March, April, May timeframe that the reverse repo facility should be at zero if the Federal Reserve does not slow down the pace of quantitative tightening. Let me actually pull up bank reserves. So bank reserves, Fred. So if they do not slow down the pace of their quantitative tightening, I fear that they are actually going to end up impacting bank reserves. So historically, that has been the case. Here's bank reserves right here. So in the last tightening cycle in 2018, from 2014 to 2018, so you can see right here. So from 2014 to 2018, the idea was that they actually wanted to reduce down the bank reserves, like the total bank reserves in the system, in the banking system. And they did do that for a long period of time. So you can actually see that they conducted quantitative tightening from 2014 all the way to basically 2019. So when they do quantitative tightening, this will eventually impact the bank reserves. But this is where systemic risk can actually end up happening. So if you guys can reflect back on 2019, there was a point in the repo market where the rates started going crazy, and this was a very, very close. This is very close to a black swan event. But the Fed did respond to that, and they basically conducted a form of QE, not QE. And you can see that right here where the asset side of their balance sheet actually ended up starting to expand. So if they do not slow down the pace, once the reverse repo market goes to zero, if they do not slow down the pace by then, it's going to start affecting bank reserves, which I do think could potentially impact the volatility of the markets, which right now, the forward PE on the S&P 500 is about 20 or 21, which is very high. Typically, historically speaking, the more liquidity there is in the banking system, the higher asset prices are. So, like stock valuations in this case right here. So, if they actually do start dwindling down the bank reserves, I could actually see the S&P 500's valuation come down, which would be a form of a market crash, probably a little bit more along the lines of a market correction until the Fed pivot actually did come back. So we'll have to pay attention to that on the next FOMC meeting in March, which is really important in my opinion. But I do think that the reason why they ended up keeping rates where they were, which is 5.25 to 5.5%, is because and there's been a lot of speculation where people are talking about like, oh, does the Fed actually get the jobs report? A couple days before, especially like in major announcements or, key economic data like CPI? The answer is yes. And Jerome Powell has actually said that. I think he said that back in like 2022, where it wasn't an actual FOMC presser, but it was like a question and answer session where he said that usually during times when there's major data releases that they will receive these reports a couple days early, him and the other Fed voting members, where they can see this to make sure that they're making an accurate, as much of an accurate decision as they possibly could. And the jobs report was actually really hot. So you guys can see that about 317,000 jobs were added during this latest quarter. Latest month, which was going to be January. So, and that was a lot higher than what they expected at about 170. But what really concerned me the most is actually going to be the wage growth, where we saw that come in at 0.6 month. I think it's 0.6% month over month. Yes, it's 0.6% month over month, over the expectation of 0.3, which obviously increased the year over year number. Now, the reason why this is important, the reason why this is kind of scary to me, is that this increases the chances or the likelihood of a wage price spiral. Now, one report isn't enough for me to say like, "Yep, we're screwed." Right now, it's just kind of like, okay, maybe that's something that we should keep an eye on, especially when February's jobs report comes out. So I do think that that's a huge reason why they ended up pausing rates in January and then punting to March. And especially even like reducing the chances and basically taking the March rate off, the March rate expectation off of the markets, right? So we can actually take a look at this, where the March meeting is now at about 15.5% chance of a cut, and about an almost 85% chance of a pause on that March meeting. I do think that this hotter than expected jobs report did have something to do with this. I mean, I can venture so much as to say is that I know, you know, we definitely don't want a resurgence in inflation. I think that if there was a resurgence in inflation, that would definitely be cause for a market crash. So next, looking forward, what we're really seeing is that we're probably going to cut in May or June. So May has, if we add these two together, let's just say that's about a 70% chance, like a 65 to 70% chance of a cut in May. And in June, this is basically the month here where we're almost at 100%. So you can see that right now, this is where our current rate is, the 5.25 to 5.5. There's only about a 4.8% chance that this actually is like held by the June meeting, where we have not just one, but we have two rate hikes priced in. So we could see a 50 basis point cut at that next meeting. Sorry, I just had somebody message me. I want to make sure that I'm answering any questions. So Krishna said, I think jobs added more due to seasonal hiring during December. I think so too. There was a lot of revisions, especially on this jobs report, and a lot of seasonal adjustments. And if you guys can remember, in 2023, a lot of people panicked on that January jobs report because there was so many seasonal revisions. This does happen. I mean, there's going to be some reports that are a little outliers, like a Four Sigma event. That's not common. That's not normal. So what I really like to do is I like to zoom out and then zoom back in. In this particular case, it's like, okay, knowing that sometimes we're going to get these reports, like where are we currently at in the cycle? The best way to think about that is, you can see the Fed funds rate cycle right now. We're still at that pause level. Where historically this is about the time where there's going to start being some volatility. When the Fed pauses for an extended period of time, I think what I'd like to do is actually take a look at the inverted yield curve. So the 10-year and 2-year spread, because I didn't take a look at this, but I want to make sure that I'm watching this, because this is going to tell us basically when. So the best way to think about this here, especially on the inverted yield curve, is it's not until the yield curve uninverts fully. So you can see right here that it was basically May of 2007, yield curve uninverted. And then it wasn't until about 6 months later that we actually had the recession begin in 2008. Same thing ended up happening here in 2007. It wasn't until about 3 months later in March of 2001 that we saw the beginning of that economic recession. So 3 months here, 6 months here, and then this was about 3 months as well. So it looks like we uninverted, we danced around for a while, and then we steepened, and that signaled the beginning of the recession. So that's what I'm really watching for right now, is what happens when we actually uninvert, and then is there going to be a steepening of the yield curve? If that does end up happening and the bond market is signaling that recession, then that's about the time where we're going to have to start throwing up our cautionary hats and say, like, maybe it's time to take some money off the table. Probably time to play a little bit more defensive, hedge your portfolio if that's what you're into. I'm personally going to raise some cash probably, and just prepare. There's nothing wrong with just preparing for a little volatility. The markets obviously do go up over time, but sometimes preparation is going to be key in protecting some of that downside, or even just having enough cash as opportunity to take advantage of the dip. Like that's how I look at it. Is that I'd hate for stock prices. I don't care if stock prices go down, but what I want to do is I want to make sure that I have enough cash to take advantage of lower stock prices. Because if stock prices are going to be discounted, 20, 30, 40%, it's obviously a good idea to have something laying around to be able to take advantage of those lower stock prices and really fuel our longer term gains. So from an economic, like from a Fed rate cutting cycle, I don't think that as it stands here today, right? As it stands today, pending any black swan event, I don't see a reason for the markets to fully crash right now. Inflation is well managed, right? So PCE came in better than expected. The unemployment rate is still low, and we're watching the jobless claims come out, which is every single week on Thursday. We can continue to watch that, especially the continuing claims. We want to make sure that we're paying attention there, paying attention to that inflation rate, paying attention to the jobs market, making sure there's no wage price spiral, just to make sure that there's really no rationale still for the markets to crash. Because if there's no reason for the markets to crash, they just usually, historically, they don't crash. Hopefully you guys cannot hear that dish or our washer in the background. My wife actually recently started our laundry, so if you guys can hear that, I apologize. So as it stands here today, I think that everything is going to be okay. I don't necessarily think that the markets are going to crash immediately in the short term. Correction, sure, yeah, we're overbought, but it's like a technical correction. All right, so let's get into some of the earnings that we ended up having not too long, or this past week. That was going to be Amazon, which was a really great earnings report. So Amazon, they ended up coming out and beating expectations, but it wasn't necessarily just the expectations that they beat that was really important or that I thought was really valuable. What I thought was really valuable is really two big things. Number one, AWS sales increased and they accelerated, and they mentioned on the call that they expect to continue to see that acceleration through 2024. This is very bullish for software and cloud stocks overall. So for me, I own, and we're going to talk about three different software/cloud stocks today. So for me, I'm paying attention to that, and I can go into this week a lot more confident, knowing that because AWS beat, because Google Cloud beat, because Azure beat, that there's likely to be some sort of continuation unless there's a fundamental problem with the business. So Amazon ended up coming out really good. And then also they had really good e-commerce sales in the back half of Q4, which I think is really bullish for Global E and even their international e-commerce. So this is something that's interesting for Global E too, is that Amazon is an indirect competitor of Global E. So for me, that's high on my caution list for that position, where if I do start to see, Amazon's international e-commerce start to, continue to accelerate, continue to strengthen, but if I see Global E stutter step or flutter, it's probably time to cut that position. But right now, I don't see that. I see a lot of consistency in between the two reports. And I do think that just in general, international e-commerce is going to be a very strong secular tailwind for a very, very long time. I mean, just think about it, closing borders. Okay, Meta as well. Meta ended up releasing a dividend, and my gosh, I think they were up like 20%. I mean, that was crazy. I think that a lot of people ended up missing this one. I know that I did, because I thought Meta was just a social media platform that my old friends from high school and in-laws, old family, I wouldn't say old family members, but like people I don't even really talk to anymore. They post about politics, right? Because that was Facebook back in 2016 to let's say 2020, 2022. So that was a huge reason why I missed that, is, especially with the whole TikTok narrative. And no one's perfect, right? Sometimes you do just miss a stock, and that happens. You catch a lot, you miss some, and that's part of the name of the game. But my gosh, did Meta produce some really good results. I mean, 24% year-over-year growth. It wasn't that long ago that they were doing like 5 or 10%, like single-digit year-over-year revenue growth. And not only that, but they also announced a dividend. What's really interesting to me is like what they're doing from an AI perspective. I still have to review these calls, or this call specifically, and figure out like what Zuckerberg is thinking from an infrastructure perspective. Like, what is he really investing into, especially when it comes down to like AI, and why is he buying so many GPUs? So like, that's what I really want to understand more. And I'll talk more about that when I feel like I actually get a good understanding. But I'm going to throw that one on your guys' radar. It's definitely something to look into. Meta's doing some pretty interesting stuff. So, well, let's talk about some of the earnings that we have coming up. Palantir, everyone's most favorite and least favorite stock. So, Palantir, let's talk a little bit about the business first and a lot about like what I expect moving forward. So, Palantir right now is going to be, I think, my second or third biggest position. I think it's my third biggest position. So, Palantir, they end up uh, becoming gap profitable just recently. So what like what I'm thinking of from here, let's actually take a look at their previous report. So we'll go here to their previous report. What I saw a lot of on this last, and this was the overarching narrative and why they even got such a boost after earnings, is that their quarter over quarter growth, and I'm thinking of one slide in particular, this one here, their quarter over quarter growth from a US commercial perspective, or like their clients, this is unbelievable. Yeah, this is quarter over quarter. So you can see 13% quarter over quarter US commercial revenue, 65% quarter over quarter US commercial deals closed. I mean, this right here, what this tells us is that AIP recently launched in like the March, April timeframe is gaining a lot of traction. That is what I want to know about in this upcoming earnings. Like, how is that business momentum continuing? And they also ended up releasing a new, I actually just saw this right here, this AIP Bootcamp. So AIP Bootcamp is their go-to-market strategy, and their go-to-market strategy has been very, very effective. And they talked about that on that last earnings call. So I want to know more about like what's going on with this AIP Bootcamp. You know, like what kind of traction is this still getting, and how is this translating into revenue, and what are their expectations moving forward? Because you could ideally see ideally, I'm not trying to get too speculative here, but this is what I was thinking is that Palantir is actually at the bottom of an S curve. If AIP is what I think that it is, which is basically a large language model that integrates, all the business's data, and you can communicate with your data to get predictive and prescriptive analytics. I do think that this is the bottom of the S curve, and they should continue to see some strength from quarter four and even heading into quarter one. So I'm really going to be paying attention to US commercial revenue. I'm also going to be really paying attention into like what's going on from their gap profitability. Are they still expanding their bottom line metric at a rapid clip? And what sort of expectations are they going to have moving forward? Because if they are bullish internally about what's going on with AIP, their AIP boot camps, and if they do have some sort of visibility into like what potential deals they could land in the months, let's say the months and the years to come, as well as like how these previous deals are going to translate into revenue, they should increase revenue guidance expectations because of the way that their deals are structured. So from Palantir's perspective, I mean, I'm bullish. I do think that this is going to be a good report. I think that the market knows that, and that's why it has a really high stock price right now. And I do think that this is a very, very long runway for growth, and it is a long time growth story. Oh, and then also I do think that this is the quarter. It's either this quarter or next quarter where they're going to be eligible for S&P 500 inclusion if they produce another quarter of gap profitability. So actually, let's go back to Seeking Alpha and see what the expectations are here. So from a quarterly perspective, they're expected at about 602 million, 602.8 million. I don't know exactly what this year over year growth is going to be. We'll see that in a second. And then they are expected to be, well, that's non-GAAP. Let's take a look at GAAP. So they're, still expected to be, this is quarter three. So it doesn't look like it has expectations, but I'd imagine that it's going to be somewhere around 3 or 4 cents. Sometimes you don't always get the non-GAAP or I should say the GAAP expectations. And you're usually going to get non-GAAP expectations because sometimes there's one-off expenses that do impact GAAP earnings. So that's why sometimes you do see that non-GAAP basically forecasts over the GAAP forecasts. So it looks like that right now analysts have them growing this year at about 19.75%. I personally think that this is low. I could see them actually growing somewhere around 20 to 25%, or maybe even 25, probably closer to 25%, possibly even 30%. And the reason why I think that is because of that commercial, that quarter over quarter growth. Like I said, I mean, it's all about like what sort of business acceleration, business momentum are we seeing on that front? If they continue to actually, land those deals, I mean, 25% year over year growth on this full year basis. We're going to know more tomorrow. That's definitely something to pay attention to. So Symbotic is, I think, a business that I could probably talk about for the rest of this time here, because a lot of people, I can see that there's a lot of misconceptions about Symbotic out there, more or less because it's always the same two things: customer concentration and no profitability. What you can currently see with their numbers and what they've been isn't what they're going to be. And you can even see that here, especially from like a non-GAAP EPS perspective. You can see that they're rapidly expanding their bottom line, and they are free cash flow positive, and they are expected to grow this year at about 49%, next year 45%, 2026 45%, right? And you can even see that it's going to have that, I'm pretty sure this is a non-GAAP PE ratio, but they are transitioning into that PE ratio. But what about from the story? What am I paying attention to as far as like Symbotic's story goes? So from their latest quarterly report, let's take a look at this. They ended up growing really rapidly. I think that what I'm paying attention to right now is like what sort of business momentum. So they've been growing triple digits year over year for the past couple of years. I'm going to be paying attention to what their total backlog is. So like, is this going to be growing, or is it actually going to start winding down? How many different customers do they have? Is it still 9, or are we going to actually start getting into 10? So when people just say Walmart's the only customer, that's not true. That's not true at all. And neither is just that CNS. Like they do have 9 customers, and the reason why they can't onload more customers right now is because of their backlog at the moment. So right now, I'm going to be paying attention to what their total backlog ends up doing. Are they going to increase that their total customer count? How many projects have they completed? Like I said, I can really go into this one and explain the business model in depth, but this is very surface level, because completed projects means something else, right? It doesn't necessarily mean like to like an outsider looking in, the completed projects or the completed sites. What this means to me is it means that recurring SaaS revenue. So like they're getting recurring SaaS revenue from about 12 different sites. And then I wanted to come down here and actually talk a little bit more about and you can see right here their key customers, their green box joint venture. That was another part of their story that I really wanted to understand. So right now, Symbotic, what they're doing is they're basically going into, just like this slide up here says, they've already went into Albertsons, CNS, and Walmart. And what they're doing is they're going in and basically setting up their warehouses to be fully autonomous, to be able to, it's basically an autonomous storage facility. Think about robots managing the inventory and the boxes, specifically organizing the boxes and then bringing the boxes forward in like this crazy, almost like it's like a symphony of robots that are just running all around, and it's like a fully autonomous warehouse. There's no other way to really say it. And what they actually ended up doing, and this is really interesting. I got another slide here for this, is they ended up releasing this green box joint venture. So right now, the way that they're making money is that they do land those customers, those 9 customers, then they contract out, and it's like about $100 billion worth of work, or 100 million. It's $100 million worth of work per warehouse. It kind of depends on the size of the warehouse. And from there, as they fulfill that parts of that project, they recognize that revenue, which is why you see that rapid revenue growth. But it's very low margin revenue, because they're selling they're selling the services, they're selling the hardware. The hardware and the services, the gross margin somewhere around like 15, 20, 30%, somewhere around there for the hardware and the services. But it's their software that they actually get that increasing that bottom line expansion. And this is running like 80% gross margins. So that's their current business model, meaning that they go into these warehouses, they do the projects, they bill the customer as the project goes along. Once the project's complete, then that's when they collect software. And these software contracts are like 10, 15-year long contracts. So they got a contract with Walmart for like 15 years. What they ended up doing is they recently announced this green box joint venture. And I got this one right here too. And this PowerPoint went a little bit more into this. They partnered with SoftBank, and what basically and it's nuts and bolts. What's happening is that SoftBank and Symbotic, they got together and they said, okay, what we're going to do is that we're going to do warehousing as a service. And what they're doing is they're basically creating and constructing their own warehouses, where Symbotic is going to treat Greenbox as a customer. So Symbotic is going to sell their product into these warehouses, and Greenbox is their customer. But they own 35%. Sorry, I'm hiccuping there. They own 35% of Greenbox, which means that all the profits that Greenbox ends up getting, Symbotic will get in turn. SoftBank gets the other 35%. But Symbotic, because they own 35%, when they sell their products into Greenbox, that they also collect that software, that recurring software from the Greenbox warehouses. So you can see warehouse 1, 2, and 3. I want to know more about like where are they at in this initiative, because warehousing as a service is something it's a big idea, right? But it's also an idea that I could see being extremely profitable, especially when you have an executive like, I think his name is Rick Cohen. And he's been the CEO of CNS, which is the largest warehouse distributor in the United States of America. So he's like the most underrated billionaire ever. I'm just kidding, not ever, but I want to know more about like what's going on with Greenbox and like what's going on with this warehouse project. This is what I hope that they do cover on the call. Like they did say in 2024 they do expect to start having warehouses live. Or at least under construction, where they did think that they could start collecting revenue and even bottom line, like cash flow from Greenbox in 2025. So I want to know where they're at in that progress. I want to know like the timeline there so that can help me understand more as I value this company. Like what sort of revenue are we going to actually end up having in the short to medium term, as well as the long term, because right now, I mean, Symbotic is an extremely hard company to value. Just because it's expanding its bottom line so rapidly, and then also expanding its top line so rapidly. Like it's very hard, and they constantly beat their expectations too, which is just, I mean, this is a company that's a very special company. I could see this being hundreds of billions of dollars. Okay, so on to Confluent. So Confluent, actually, this is Cloudflare. Let's do Cloudflare first, and then we'll do Confluent, because I actually sold Confluent after its last earnings, which is, I'll explain that here in just a minute. Cloudflare, gosh, I hate to say this because it's kind of like, I don't want to be confident ever in the financial markets, but Cloudflare, I feel good about their coming earnings. Right now, their expectations, let's just scroll down here. Let's go to their quarterly expectations. They're about 353 million. I'm sure this is somewhere around 30, 31, 32% year over year. They are expected to be non-GAAP profitable, which I do expect them to beat, because they almost always beat their non-GAAP profitability. And on a year-over-year basis in 2024, they're expected to grow 28%. I could see, because of the recent acceleration in software, I could see that this is probably going to be somewhere around 30 to 35% year-over-year growth for Cloudflare, because of Cloudflare's business model in general. So Cloudflare is, let's actually look at their, so we'll take a look at their, this is a good, okay, right here. This is really good. So Cloudflare basically operates an edge network. You can see all those little blue dots right there. Those are basically, I don't know if you want to, I guess, data centers, servers, whatever it might end up being. It's basically a part of like their, they call them Cloudflare cities. So this is basically, all right, those might actually be the cities that Cloudflare operates in. Anyway, that's regardless. It's basically where Cloudflare is, right? Their little data centers. They operate as an edge network. What this does is that this does increase the speed of the internet. And when you operate at the edge, it reduces a lot of the noise in the back end. So like it, rather than going all the way to, so like the way cloud really works, and I don't want to get too much into this because I know that I'm going a little bit over in time already. So cloud operates as like a data center, you know, like let's say over here in like Missouri, right? I don't know why I come up with Missouri, but I'm just saying Missouri. Like let's say AWS is operating a data center out of Missouri, but somebody over in New York needs something from that data center, because the cloud is basically a data center that Amazon hosts. What Cloudflare does is that they produce they have little edge networks, like basically a little edge, I guess, data centers where people can actually store things on and actually host security and web services and all those other things. So Cloudflare basically acts as internet on the edge rather than over here. So rather than this person over in New York always communicating with this Missouri location, sometimes they can actually communicate with that Cloudflare location, which does increase the speed of of the internet, and it also increases the security posture of certain websites or whatever it might end up being. So this is another huge idea that Cloudflare is just the very, very beginning of actually being able to innovate, because it's not even just the infrastructure component of operating at the edge that makes them an interesting investment, but they also are able to innovate rapidly. So you can see that at first they were just like this cloud application services or Cloudflare application services. This is like their original product back in 2018, but they've been able to implement a couple new products very quick. So now they got that zero trust services, network services, developer services, and the developer services is actually where they're going to get a lot of that AI tailwind. And then also they're putting NVIDIA GPUs into their edge networks or their edge, those little Cloudflare data centers that I was talking about before. Which basically enables, and you can see that right here that they're pitching AI. This basically enables like AI to be developed on the Cloudflare platform. And they said the CEO, I can't remember because his last name was like Prince or something like that. The CEO ended up mentioning that they've been thinking about this for like years, for like five or 6 years ago. That they said, hey, this AI thing is going to be a big deal. We're going to actually have some storage space in our data centers to be able to store these NVIDIA GPUs or supercomputers, whatever you want to say. So they were positioned for this AI opportunity. I do think that Cloudflare I'm very optimistic about them. I think we can probably see a beat on both top and bottom line, and also a raise in expectations. But like I said, never be too confident in the financial markets, because sometimes crazy things end up happening. Just like this next company that we're going to talk about here, Confluent. So Confluent, you can see that the last quarter's earnings, they were not good. And the reason why they were not good is the way that this story was evolving is that when a lot of the other software companies that I follow, like Datadog, Snowflake, Cloudflare, and a lot of those other guys, they were talking about a bottoming out in the macro conditions. Confluent ended up coming out and say that they experienced some sort of tail or headwinds from the macro conditions. When I see a break in, so I really do pay attention to like industries. This is why you see me review a lot of stocks that aren't my stocks, because I want to hear what their competitors are saying. So in Confluent's context, they ended up talking a lot about how they still had a headwinds from macro, but in this case, it did break out from the narrative of the rest of their peers, and they blamed it on two customers, and that was like 50%. So it's like, what about the other 50% of their miss? And usually they end up beating earnings. So for me, this brought a lot of questions about the durability of their business model, or even the value proposition of data streaming or Confluent in general, because what they do is they basically host manage Kafka services. And Kafka is basically the things that you get like push notifications on your phone. So if you ever get a text message from somebody, or like a Discord notification or a Facebook notification, that's a part of Kafka. That's like streaming, that's data streaming. And Confluent helps make that a reality for a lot of companies, especially on an enterprise level. But the thing for me that started going off in my head is not only did they produce weaker than expected earnings compared to their peers, but for me, the value proposition of Confluent in general started coming into question because of this. Because it's like, okay, I know companies can actually do their own managed Kafka services, but why is Confluent missing so much? And not only that, but they actually ended up redoing their entire business model, their go-to-market strategy, to do a consumption-based model for their cloud. And this is probably right here. This is probably going to be the best slide I can show you here. So the Confluent Cloud revenue right here, this is going to be their primary growth driver from their business since they basically went IPO. I mean, when they IPO'd, it was like 150%, or even like, I think it was actually 210% when they first IPO'd, year-over-year growth. So it had just amazing traction. But over time, I've seen that growth decelerate, which is to be expected, especially when you start hitting higher revenue numbers. But when you start seeing cloud revenue miss, when the other cloud companies are actually beating expectations, and then you start bringing into question about like what's the overall moat of Confluent. This is really what I want to see. I'm going to be paying attention to Confluent because I'm more than happy to reinitiate a position higher than the price that I sold it at, which was like $16 a share, which is kind of dumb on my point because it's like $23. But hey, you can't win them all. But I'm more than happy reinitiating this position if during this call that they do provide a lot more clarity about their overall like moat that they have towards their customers. But if they do produce bad earnings 2 quarters in a row, I do think that this is a huge red flare about the overall like value proposition of Confluent in managed data streaming. So I that's definitely something that I'm going to be paying attention to is, are they going to beat again? If by so, how much? Are they going to raise expectations? What's the overall like initiative, or how's the progress looking on their new go-to-market strategy, which is now transitioning towards a consumption-based model like Snowflake, MongoDB, and Datadog? They do consumption-based models. Like, how is Confluent going to be doing something, or how are they progressing along this initiative? So those are some of the key things that I'm going to be looking for from Confluent. But I do think that that's all that I had to share here as far as like some of the earnings that are coming out. I do know that this is going to be an interesting week. I love earnings week. I'm always going to be here for you guys. If you guys have any questions, make sure that you just comment down below. If you're watching on YouTube, make sure you give that thing a like. Subscribe if you're not already subscribed, or maybe give that this live stream a heart on X if you guys are watching on X, or whatever it might end up being. But I appreciate you guys, and until next week, I'll see you later.